Hello and welcome. Today, we are diving into economic indicators. These are essential tools that help us understand the health and direction of an economy. For anyone interested in finance or investing, knowing these terms can provide valuable insights into how economies grow, change, or face challenges. Economic indicators like GDP, inflation, and interest rates don't just tell us about numbers on a page, but they affect everything from our investments to our everyday costs. By understanding these concepts, you will gain the knowledge to make more informed decisions. You will interpret market trends better, which is incredibly useful for anyone involved in finance. So, let's explore what these indicators mean and why they matter to you. First is Gross Domestic Product. Gross Domestic Product, or GDP, represents the total market value of all final goods and services produced within a country. It is calculated over a specific period, usually annually or quarterly. GDP acts as a broad measure of a country's economic health. It is divided into four main components: consumer spending, business investment, government spending, and net exports. When GDP is growing, it generally indicates a healthy, expanding economy with rising productivity and potentially more job opportunities. However, when GDP declines, it can signal economic slowdown or even recession. For investors, GDP growth is often associated with a positive market outlook, as any businesses tend to perform better in growing and favorable economies. Understanding GDP can help beginners track economic health and anticipate market trends. Next is the Consumer Price Index. The Consumer Price Index measures the average change over time in the prices paid by urban consumers for a basket of goods and services. The goods and services may include food, clothing, and healthcare. The Consumer Price Index is a critical indicator of inflation. It shows how the cost of living evolves over time. When the Consumer Price Index rises, it indicates that consumers are paying more for everyday items. This rise can impact spending and saving habits. For investors, Consumer Price Index trends can influence decisions, as rising inflation often leads to interest rate hikes. This can affect stock and bond markets. Knowing how the Consumer Price Index works can help beginners understand inflation's impact on purchasing power and investment returns. The Producer Price Index measures the average change in prices that domestic producers receive for their goods and services. While the Consumer Price Index focuses on prices from the consumer's perspective, the Producer Price Index looks at costs from the producer's end. It covers sectors like manufacturing, mining, and agriculture. Producer Price Index is often considered a leading indicator of consumer inflation, as the increases in production costs can eventually lead to higher prices for consumers. For investors, watching Producer Price Index trends can provide early signals about inflationary pressures. It can also signal potential changes in consumer prices. Learning about the Producer Price Index can give beginners a more complete view of price changes and inflation. Interest rates represent the cost of borrowing money or the return on savings. They are typically set by a country's central bank. Interest rates are fundamental to the economy as they influence consumer spending, business investment, and the cost of financing. When interest rates are low, borrowing becomes cheaper. This can spur economic growth by encouraging people to spend and invest. However, when rates rise, borrowing becomes more expensive. This can potentially slow down economic activity. For investors, changes in interest rates affect various asset classes differently. The higher rates often make fixed income investments more attractive. Understanding interest rates is essential for beginners, as it impacts both personal finance and broader economic trends. Next is inflation. Inflation is the rate at which the general level of prices for goods and services rises. This leads to a decrease in purchasing power. When inflation is moderate, it often signals a growing economy. However, high inflation can erode the value of money. It makes everyday expenses more costly. Central banks monitor inflation closely, often raising interest rates to control high inflation, which can slow down economic growth. For investors, inflation can impact everything, from stock performance to bond yields. Understanding inflation helps beginners anticipate changes in the economy, and also how it may affect their investments and savings. Deflation is the opposite of inflation. This describes a general decrease in the price level of goods and services. While this might sound beneficial at first, but prolonged deflation can signal economic trouble. Deflation is often linked with reduced consumer spending and lower company profits. In deflationary periods, businesses may struggle, leading to job losses and slower economic growth. For investors, deflation can mean falling asset prices and lower returns. Recognizing deflation helps beginners understand economic cycles and the potential impact on their investments. This is a good tool to learn, especially in markets sensitive to changes in consumer demand.